It's game over for Credit Suisse. The historic Swiss bank has officially been taken over. Now, UBS, a rival bank, has stepped in and bought Credit Suisse in a dramatic twist of events. And we know Credit Suisse has been in crisis mode for many months now, and they are finished. But understand this is a lowball offer for the bank. UBS is paying only 3.25 billion for Credit Suisse, and that is 60% less than what the bank was worth just last Friday. And if you are a shareholder of Credit Suisse, you just received the beating of a lifetime. The stock price is down by 90%, and if you didn't sell, you will be taking a huge discount when they convert your positions to UBS shares. And we are talking about 0.76 francs in UBS stock that was once worth 1.86 francs last Friday. And this is the disaster for the Swiss banking system. And here's the kicker. Shareholders didn't even get to vote on whether they wanted this takeover to happen. This was a rushed deal. Regulators, they allowed the takeover to proceed without consulting the shareholders of either UBS or Credit Suisse. And this tells us the magnitude of the panic and how afraid the Swiss banking system was if the deal didn't go through. They were afraid of a systemic collapse. And I want us to recall the $54 billion lifeline Credit Suisse had from the Swiss National Bank. The government was panicking that if the bank fails, the whole system would collapse. So they stepped in, but it wasn't enough. Investors were spooked and they decided to run away. And one of the biggest casualties of this takeover is the Saudi National Bank, losing $1.2 billion on their Credit Suisse stock. And as you'll quickly see, this carnage isn't over. The banking system is now experiencing a crisis of confidence, and as Jerome Powell keeps hiking rates up, more things are going to break in the financial markets. And what we are seeing is trust in the system eroding and the contagion spreading. And the Swiss government cannot let Credit Suisse fall. It could trigger a banking meltdown not just in Switzerland but on Wall Street as well. Depositors will get spooked, and if a too big to fail bank collapses, maybe theirs might be next on the list. The Swiss president himself came out to say an uncontrolled collapse of Credit Suisse would lead to incalculable consequences for the country and the international financial system. So understand what just happened. This was a bailout for a too big to fail bank. Credit Suisse is in the list of the G-SIBs that includes JP Morgan, Citibank, and Bank of America. And this means it's a systemically important bank. And as we have talked about this many times, as long as you are on this list, it's very likely you will get bailed out. They won't let you experience a total collapse. Yes, the taxpayer isn't directly involved in the Credit Suisse takeover, but this is a private sector solution, right? But the Swiss government had to step in and work the deal over the weekend. UBS didn't really need to buy Credit Suisse. They could just let them fail and all the business would just naturally flow to UBS over time. So why did the bank decide to go ahead with it? Maybe it's because of the list of guarantees the Swiss government gave UBS. The government intervened to prevent a total collapse of Credit Suisse. And you quickly understand why UBS decided to bite. And to assist the takeover, the government provided UBS with a loss guarantee of up to 9 billion francs from potential losses arising from certain assets. This means if UBS experiences specific losses as a result of the takeover, the government will compensate them. But the assistance goes further. The Swiss National Bank also provides a credit line of 100 billion francs to UBS. So if anything goes wrong, UBS has access to a mountain of cash straight from their central bank. In fact, according to Reuters, the assistance could be much more. We are talking about 260 billion francs in state and central bank support. That is almost a third of the country's GDP. Yes, UBS, they bought Credit Suisse, but it was under the backdrop of huge guarantees from the Swiss National Bank. So ladies and gentlemen, let me know if this is a bailout or not, because it suspiciously smells like one. But the story gets worse. Bondholders of Credit Suisse just got a nasty wake-up call. Credit Suisse, they wiped clean $17 billion worth of debt. It is now worthless. And because of the UBS deal, Credit Suisse had to write down $17 billion worth of additional Tier 1 bonds. And here's the controversy. When a company goes bankrupt or write-down happens, the shareholders should be the first to take a hit. The bondholders should be the ones that receive compensation first. So if you're a bondholder and I'm a stockholder, you should get paid before me. You get first dibs. But how could this happen? How could the bondholders get screwed? It's because of the type of bonds these were. Now, these are called contingent convertible bonds or COCO bonds, right? These are often described as high-yield investments with a hand grenade attached, and let's explain why. Now, back in 2021, Credit Suisse wrote a report hyping up COCO bonds, calling them an attractive investment opportunity. Remember back in 2021, the 10-year yield on Swiss government bonds was negative, making them a horrible investment. You actually lose money by loaning cash to the Swiss government. Who would want to do that? But the cocoa market offers yields above 3.6%, and that's more than even the European high-yield bonds at 2.8%. So on the surface, this sounded like a great deal. But here's the hand grenade part of the deal. Here's the contingency part of the cocoa bond. Their status can change if the bank's capital falls below a certain level. They can convert the bond into equity or shares of the bank, or in a worst case scenario, they can completely write off the bond, and that means you receive nothing as a bondholder. That is the nuclear option, and guess what? The unthinkable did happen. And this is the purest form of counterparty risk. You have no control over how the bank will react when they are collapsing. Now, this isn't really the bank's fault. Bondholders should have known better. You can't expect to get a better return without risk, and this was a risky bet. But here's the interesting part. It wasn't decided by UBS. According to their CEO, the decision to wipe out cocoa bondholders was done by the regulators. So they really wanted this deal to be done to prevent a total collapse of Credit Suisse. And this tells us how fragile the banking system is. We are starting to see the safest instruments, bonds, implode before our very eyes. First, it was SVB's treasury bets gone wrong. Now it's Credit Suisse cocoa bonds crashing down to zero. Remember guys, this is happening at a Fed funds rate of 4.5%. And we need to take higher interest rates more seriously. What will happen at 5 or 6%? What else might implode? But here's the big danger of this cocoa bond write-down. Bondholders, they are getting a first-class education on the term counterparty risk, especially if they are holding high-risk debt. We are now seeing bondholders dumping their holdings of the risky AT1 bonds across Deutsche Bank and UBS. This bond dump is getting worse because investors are now starting to wake up. And this is how bad it is getting. According to Reuters, we have a UBS AT1 bond callable in January 2024 at a yield of 29%. That is an insane jump from 12% yield just on Friday. And this tells us that investors, they are terrified of a write-down, that they are demanding almost 30% yield for the bond. We have an ETF that tracks AT1 bonds collapsing in price because everyone is truly afraid. So just imagine if you're a bank, now it is much harder for you to raise contingency money. Thanks to Credit Suisse, bondholders already believe the debt could be written off if the worst happens. We are now starting to move from a liquidity crisis towards a credit crisis, which is much worse than a bank run. Because at least in a bank run, if you hold up to $250,000, the FDIC will make you whole, or in SVB's case, the Fed will save you. But in a credit crisis, the gears of finance start grinding to a halt. In a credit crisis, people are afraid to lend money to each other. Investors, they are too scared to lend companies and banks money. And because liquidity from loans is drying up, banks stop issuing loans themselves because now money is expensive. They are also afraid of people defaulting on their mortgages and bank loans. Suddenly, the entire financial system freezes up and money stops flowing around. Look, I know this sounds like a doomsday scenario, and I know we have Janet Yellen telling us that everything is fine even after we had two American banks failing. But we need to ask ourselves the big question of what if. I'm gonna sound like a broken clock, but this chaos is already happening at just 4.5 interest rates. Wait till we go higher. So what are the signs of a credit crisis? How do we know if the system is grinding to a halt? Now, the recent bank runs are already adding pressure on banks to conserve their capital. And this means banks are starting to tighten their lending. They are being very selective. And it makes sense. There's always a bank run around the corner. And if your bank is targeted and you need to sell assets to pay back depositors, it could be game over for you. And now there are multiple calls for the banks to tighten their lending standards. And this is going to contract credit and the flow of money even further. We have a strategist from JP Morgan telling us that banks today are tightening faster than back in 2020. We are just a disaster or two from a full-blown credit crisis. So what will be the trigger? Now, I believe it could come from the investor side when they experience a full crisis of confidence. All it takes is for a bank to default on their bonds for chaos to happen. And I mean the normal bonds that can't be converted into shares or written down. Now, if that event happens, it'll be the equivalent of the sky falling down. But if investor runs continue and liquidity starts draining away fast enough, anything is possible in our brave new world. And guess what? Central banks are already preempting this credit crisis. They are rushing to keep cash flowing through the system. They know they have to prevent more bank runs and maintain confidence in the system, or everything will fall like a house of cards. You have the Bank of Canada, the Bank of England, the BOJ, the ECB, the Federal Reserve, and the Swiss National Bank all panicking at the same time. The G7 banks have banded together to enhance the provision of liquidity via the standing US dollar liquidity swap line arrangements. Basically, they are moving to keep the flow of US dollars pumping through the financial system. Janet Yellen herself knows that we are on the brink of a credit crisis. During her testimony last week, she told Congress if banks are under stress, they might be reluctant to lend. We could see credit become more expensive and less available. If we get a credit event where money stops circulating around, we will start to see asset prices across the board crash. Stocks and real estate will start to slide down if money dries up. But here's the interesting thing. If a credit crisis happens, there will be two likely winners in this scenario. Now, the first is obvious, and that is government bonds, because there can never be a liquidity crisis when it comes to treasuries and bonds. The government can just print up new dollars to pay you back, right? Maintaining your purchasing power, that's another thing. But hey, at least you will get paid back. Now, the second could very well be gold. Now, if a credit crisis happens, it will be in a highly inflationary environment. Inflation is still at 6%. That's 3 times above what's considered normal. So if money is afraid of flowing into stocks and corporate bonds, but inflation is still high, a huge chunk of money could move into gold and beat up prices even more. And what we have now is two storms on the horizon. We have a bond crisis brewing and a banking consolidation already happening. And if the Federal Reserve keeps hiking rates up, which could happen again just in a few days, even if it's just a 25-point hike, something else could break in the system. And you know, things are really bad when the Biden administration has to run to Warren Buffett for help. Maybe the next bailout might be from the Oracle himself. It wouldn't surprise me if Berkshire Hathaway bails out yet another bank. They bailed out Goldman Sachs with $5 billion back in 2008, and in return, Buffett made a handsome $3 billion from the deal when he sold out in 2020. This could happen again. So brace yourselves, guys, because this banking crisis isn't over yet. The devil has come back to collect. But let me know what you think in the comments below. Are we moving towards a credit crisis soon? Is a recession just around the corner? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.